As the global economic landscape undergoes seismic shifts, a concerning trend has emerged that could have far-reaching consequences for investors and markets alike. Corporate profits, once the bedrock of a thriving stock market, have been on a downward spiral for 9 consecutive months. This persistent decline in corporate profits is sounding alarm bells and raising concerns about the potential for a stock market collapse. In this video, we delve into the factors driving this decline and explore the potential implications for investors and the broader economy. I'm interested to hear your perspective on the current state of the stock market. Are you leaning towards a positive or negative outlook for stocks? I'd like to bring your attention to some noteworthy indications that point towards a potential downturn in the stock market. I'll be presenting these warning signs, followed by an examination of both sides of the argument. I'll provide insights into the bullish case as well as the bearish case. So let's dive in. Let's clear the air. I am not here to incite fear or to be negative. A dire economic depression isn't anticipated within this economic cycle. The goal here is simply to provide the data, ensuring that investors are well prepared and set their expectations realistically. With that being said, let's get going. To begin, let's discuss corporate earnings. As we analyze the recent landscape, it's important to note that approximately 90% of companies listed on the S&P 500 have already disclosed their second quarter earnings. Unfortunately, the results are far from promising. They're actually quite concerning. Comparing the current corporate profits to those of the previous year, we observe a decline of around 5%. This performance stands as the weakest since the year 2020, with corporate profits having now experienced a consecutive 3-quarter decline. The intriguing aspect here is that this decline might not be immediately apparent if one solely relies on headline news. The reason behind this subtlety lies in the reticence of mainstream media to convey the truth, the fact that corporate profits have been on a downward trajectory for a staggering 9-month period. This earnings season, an astounding 80% of companies have managed to surpass the expectations laid out by analysts. It's truly something to ponder. That figure is indeed quite remarkable. I'm not joking. You might have personally witnessed instances where companies report a slump in their sales and profits, yet miraculously they still manage to outdo analysts' predictions. Historically, corporate profits have been a reliable indicator of the health of both individual companies and the economy as a whole. They reflect a company's ability to generate revenue and effectively manage expenses, serving as a fundamental measure of financial success. However, recent months have witnessed a prolonged decline in corporate profits, signaling a fundamental shift in the business landscape. The correlation between corporate profits and stock market performance is deeply entrenched. When corporate profits decline, investors become wary of the underlying health of companies and their ability to generate future returns. This sentiment often triggers a chain reaction of events that can contribute to a stock market collapse. Recall my initial cautionary note at the commencement of the earnings season, wherein I shed light on this phenomenon. If you recollect, I pointed out that it's vital to grasp the underlying maneuver. Analysts deliberately set their anticipations remarkably low, and this tactic serves a clear purpose. Were it up to me, I would question the competence of these analysts. After all, how can they consistently underestimate outcomes a whopping 80% of the time? However, neither you nor I are likely naive individuals, and I believe you comprehend the dynamics at play here. You've grasped the game in motion. You are aware that a strategic manipulation is occurring, and the whole charade seems rather ludicrous. Yet, let me share a nugget with you. The antics of these analysts and their contrived estimates are no longer pulling the wool over people's eyes. The evidence to this effect is quite telling. This is a snapshot of how stocks have been responding post the company's earnings release, particularly when they manage to outdo expectations. Let's delve into the past 5 years, dissected by quarter. Take a close look at the current quarter. A whopping 80% of companies are defying the odds and surpassing expectations. Yet, the intriguing pattern is that the stocks are not soaring. Instead, they are dipping, and not just by a tad, but more profoundly than usual. Perhaps this could be attributed to the fact that people are no longer falling for the ruse of these analyst projections, sensing their artificiality. I want to extend a message, a clear note to Wall Street and the financial analyst community. It's imperative that they grasp our awareness. We've deciphered their tactic. It's crystal clear that they're deliberately lowering the bar to facilitate a scenario where a staggering 75 to 80% of companies manage to outperform expectations. We're not oblivious to this maneuver. The curtain has been pulled back on this game. A resounding call goes out to them. Put an end to this charade, for it's growing increasingly absurd. My personal mission is to raise a flag of alertness, to educate people about the plays in Wall Street and mainstream media. It's crucial to unveil the truth behind these manipulations and fabricated news. When you encounter headlines proudly proclaiming companies like Apple surpassing expectations, I urge you not to be deceived. The reality often lies beyond those bold lines. If you read beyond the surface, the actual narrative unfolds before you. Sales dwindling, profits dipping, yet somehow miraculously surpassing analyst predictions. Now, let's pivot to the back-and-forth exchange between the bulls and the bears. On one hand, the bulls assert that despite the slide in corporate profits, we've crossed the roughest terrains. Their narrative predicts better days ahead, and intriguingly, this stands as the consensus forecast. The consensus outlook places Q2, covering April through June, showcasing a 5% contraction in corporate earnings. However, turning the spotlight onto the subsequent quarter, Q3, spanning July to September, the prognosis holds a modest rise of 0.2% in corporate profits. Yet, the narrative for Q4 is nothing short of exuberant, predicting a meteoric surge with corporate profits soaring by an anticipated 7.4%. But here's the crux. I'd like to emphasize a trend that's quite the deja vu. Let's delve into the past 7 months, specifically zooming in on the Q3 and Q4 corporate profit projections. If you scrutinize the graph, you'll see 2 lines, the Q3 expectations and the Q4 expectations. Now, observe how they've been shifting with time. The intriguing revelation is that these projections aren't set in stone. Instead, they keep slumping, sinking further as the clock ticks. Take the case of Q3. Initially, there was an optimistic anticipation of a 5% surge in earnings growth. Fast forward, and you'll notice how this aspiration has tumbled significantly, settling at a meager 0.2%. The same phenomenon unfolds for Q4. At the outset, there was a buoyant forecast of a 10% upswing. Yet, as time progressed, this optimism experienced a considerable setback, dwindling down to a more conservative 7.4%. Keep in mind, Q4 results are about 8 months away from revelation. This interval leaves ample room for fluctuations in these expectations. It's a realm of uncertainty. Who's to say that these expectations won't sway further, potentially dipping into negative or near zero territory over the course of these months? Thus, witnessing a shift isn't improbable. It's the norm in this dynamic landscape. All right, let's delve into the bulls' perspective. They're building their case on 2 primary pillars. First up, they're highlighting the robustness of the U.S. consumer base as a major driving force. The second cornerstone of their argument is the advantageous boost coming from the leaps and bounds achieved in the realm of artificial intelligence, leading to significant productivity gains. However, it's crucial to note that I've meticulously delved into the counterpoints to these arguments. In fact, I've recently released a comprehensive video where I extensively dissect the current macroeconomic landscape. The crux of the matter is that we're navigating through turbulent waters of high interest rate territory, and the Federal Reserve doesn't plan on slashing these rates until the distant horizon of 2024. As a result, our economic terrain is taking on a rather challenging hue. Let's zoom in on the bottom line. The reality on the ground is that a multitude of Americans are grappling with a slew of financial hardships. The statistics paint a grim picture. Home affordability is spiraling down to record lows, credit card debts are scaling unprecedented heights, delinquency rates are on the rise, foreclosures are casting a long shadow, unemployment is poised for a troubling surge, and the looming reinstatement of student loan payments isn't doing any favors either. These factors are collectively fostering an environment that's hardly conducive to a soft landing. However, the bull camp isn't entirely swayed by these disheartening realities. Some bulls are conceding that a considerable chunk of these concerns holds true. Yet, they're offering an intriguing perspective. The stock market, in their view, stands somewhat apart from the real economy. In other words, they posit that while economic turbulence rages on, the stock market can continue to chart its own course, seemingly unaffected. They're essentially arguing for a certain degree of detachment between these realms. Nonetheless, it's worth pondering whether this detachment can be a lasting phenomenon. While it might persist for a while, one can't ignore the inherent link between the stock market and the tangible economic landscape. The web of interconnectedness, I believe, can't be severed indefinitely. Ultimately, when it comes down to the stock market, it's all about the fundamental factors of corporate profits, dividends, risk, and rate of return. These factors are intrinsically tied to the real economy. Let's delve into a fascinating graph by RIA, showcasing the dynamic between real profits and the fluctuations in the S&P 500. A noticeable pattern emerges, a cyclic movement and a point of intersection. Over the past few years, stocks have been outshining their actual profits, a trend often attributed to the influence of the Federal Reserve's monetary policy. However, these periods of divergence from reality are transient, as history shows. The bears argue that any economic recession will act as a corrective force, curbing the excesses. Even if the recession is mild, its effects on the markets can be swift and profound due to the existing state of overextension. As we examine valuation metrics, the current scenario seems less than sanguine. Presently, the 12-month forward price-to-earnings P/E ratio on the S&P 500 stands at 19. This places stocks in the realm of being decidedly unaffordable, especially when contrasted with the 5-year average of 18.6 and the 10-year average of 17.4. What do the significant players in the financial landscape have to say? Let's weigh in on some opinions from prominent institutions. The chief market strategist at JP Morgan raises a red flag, indicating that the rise of AI is creating a bubble in the stock market, one that might be on the verge of bursting. BlackRock, the world's largest asset manager, anticipates an erratic inflation trajectory, a scenario that doesn't bode well for stocks. On a brighter note, RBC paints a bullish picture, predicting that the stock market could embark on a cycle that propels the S&P 500 to a lofty 14,000 by 2034. This translates to an average annualized growth of 10% over the next 11 years. Your input matters greatly, so please share your thoughts in the comment section below. From my perspective, it seems apparent that a significant portion of the American population is grappling with financial challenges. Moreover, inflation figures, as reported by the government, might not entirely mirror the reality on the ground. It's evident that wage growth hasn't kept pace with inflation, and this disparity is felt acutely by those relying on fixed incomes like Social Security. The rosy picture painted by mainstream media doesn't entirely reflect the nuanced complexity of the situation. The objective is to veer away from the herd mentality and the influence of propagandist narratives. I hope you like this video. If you find this content insightful, consider subscribing for more updates. Thanks for watching. Until next time.